Hello and welcome to Crux Investor. We caught it with Mark Selby today, CEO of Canada Nickel. They had a huge year last year and this year looks to be more of the same. We talk about the PEA which came out yesterday, some big numbers in there. He explains how he's going to tackle the market, how this thing gets funded and the race towards a feasibility study by the end of next year. And if you want to see precisely what we talked about, you can take a look in the description below. And don't forget to give us a like and leave your comments. Mark Selby, how are we, sir?
Very good, Matthew Gordon. How are you?
I'm fine. I wanted to talk to you about your PEA. You've got it out.
Yeah, we did.
On time, on schedule. Some nice numbers in there.
No. We did delay it, through a couple of times there. But, at the end of the day, these are the numbers that we're going to be living with, talking to partners, talking to government officials that we're going to be using with permitting. So it was important to make sure that we got it right. And again, very, very happy with where the numbers came out, with nearly 2 billion pounds of nickel at a cash cost of $1 a pound, all in sustaining cash cost of $2 a pound, and IRR at 16% over $1 billion NPV. And, from a, cash flow perspective, over 400 million a year in EBITDA and nearly $300 million a year in free cash flow over a 25-year mine life. And really, today's PEA, I think that one of the key messages, this is really just the tip of the iceberg. We're just getting started with this project at this point, 20 months in from the very first drill hole. So, there's still a huge amount of upside from here.
No, I mean, it's a huge project. It's got real scale to it, and I get the multi-cycle component to it. Can I just get a little bit granular with you? Do you mind?
Sure.
You did delay it a couple of times, and I think people were concerned about that one. One was around the discussions ongoing discussions with Glencore, and the second was around grind size. I mean, did you benefit from that delay as a result? Did those two topics get resolved?
Oh, for sure. I mean, in terms of with Glencore, we did the key pieces were, doing the capital cost and understanding the operating cost of retooling one of their mill lines at Kidd Creek. We've got both those numbers. Both those numbers came in line with what we were expecting. What we didn't get done in time was just the discussions around, what the business terms of something like that would look like. So again, that opportunity is still on the table. And, that one's not so much more about adding value. It's just being able to de-risk the project at a capital cost of closer to $100 million than $1 billion.
Right. Okay. And let's just talk about the scale of this, because it's big out of the gate. You're sort of, I guess, comparable to something that we're used to talking about, which was Dumont in 20 months. So obviously it's happened in an accelerated time frame. How do you move this thing forward now? Okay, you've said, right, here's some big numbers.
Yeah.
Great. It's PEA. Yeah. Now what?
Yeah, no, in terms of, again, sort of, this tip of the iceberg, unlike most companies, which would have spent, most juniors have spent a lot more time drilling the resource off before they started the PEA. We basically have a resource that we locked in last October, to do the PEA. We've been drilling significantly since then. We're going to continue to drill through the summer. We'll have a resource update out at the end of the year, early next year for the resource that'll be used for the feasibility study, and that'll be 50 to 100% bigger than what we've got today. What we're looking at is we've in today's PEA we paid to build out 120,000 ton a day operating mill using the ore that's available today. But there's going to be lots of opportunity to get higher value. That's another $5 or more a ton NSR or lower cost than what's in that plan today. And every ton that we drop in, that incremental value or that incremental cost saving drops right to the bottom line. So that's just one big piece of it. In terms of again, we have a distinct downstream path. Looking at using off the shelf RKEF AOD approach that they used in Indonesia and China. And again, we get paid for the iron and the chrome, and there's massive upside in terms of being able to optimize the recovery for both the iron and the chrome, because we were pretty focused on this first stage just on optimizing nickel recovery. And so again, expect to see substantial improvements in both the iron recovery and the chrome recovery. And I think we can squeeze out another couple points on the nickel recovery by the time we're done here.
So I want to try and answer a question to myself, which is, this thing's been, you had a barnstormer of a year last year. Your share price, through the roof. Your shareholders are very, very pleased. But I want to understand how real this is. How have you mapped this out? Is this just a marketing exercise, or has it got substance and it's actually going to get into production? So with things like you just mentioned, iron ore and chrome, what pricing are you using? Are you using something that's justifiable?
Oh, no, for sure. I mean, in terms of, our long-term nickel price, if you look at the range, most projects have been done between $7.75 and $8.50 a pound, and we're sitting at $7.75. In terms of how the input feeds into stainless is used, and I realize this is new for some people, is on an iron basis, it's the scrap iron value that's available in the local marketplace. So, that value for the U.S. Is what we're using. And again, that's something people don't forecast. So we use the 10-year average for the US market, which is $290 a ton. And again, that's not per ton of iron ore, that's per ton of iron that's contained in the final product. So again, I realize that's a little bit new for people. And then the other key component there is chrome. And again, there's not a lot of people who forecast that number, but the number we're using is tied off a Europe forecast with an appropriate discount between the US and Europe. And that number is in line with what we've seen, or lower than what we've seen in the US market in recent years. So all three of those numbers are relatively conservative, and today's current prices for iron and chrome are much higher than those prices that we're using today.
Right. And so you're saying this industry standard, that's a fairly normal way of doing it?
Yeah. Okay. Yeah. No, that's all we're doing, and using a 10-year average, because there's not a lot of good forecasts out there, or not a lot of forecast period.
Okay, and you're focusing on the stainless steel market. Why? There's a massive EV revolution going on, Mark.
Yeah, I know. I've obviously missed the boat. The reason we're doing this approach right now is fundamentally market driven. If you look at the U.S. stainless market and the European stainless market, the premium that's available by producing that product per pound of nickel is over $5 a pound in the U.S. market, and it's been like that for years, and it will continue to be like that for years. It's a very protected market. So even though there's been cheaper stuff available from China and Indonesia, and if people really understood the nickel market, and I think some people pretend that they do and they really don't, you'll see that these premiums are available, making a very straightforward product. So yes, the premium for sulfate, has been around $1 a pound plus or minus. It's a big spike right now in China that we've talked about on our weekly nickel show. But in terms of sustainable premium available in the market, U.S. stainless steel using off-the-shelf RKEF AOD technology, not some sort of unproven hydrometallurgical approach that people will hope will work. This is a guaranteed lowest technology risk path to market, that we think, would be available today. And the payability terms reflect, giving a third party a great big profit margin, to give them the incentive to do that. We think people will be very interested in co-locating a plant with us because, again, we believe we'll not only be zero carbon in terms of our own nickel, cobalt, and iron production, but have enough credits to be able to allow that person's production using our product will also be a zero carbon product, which, again, given what's going on in the marketplace today, we think would be a pretty attractive proposition going forward.
So your product is good enough to sell into the battery market, but you're keeping the optionality at this point. How are you looking at it?
Oh yeah, for sure. No, this is what's best today. I fully expect by the time we get the plant built and feasibility study that there'll be a separate processing plant where we'll take our highest grade nickel concentrate that's available in the marketplace today, and have those nickel units and the associated cobalt and PGMs, which again, we've got zero value for, again, back to the tip of the iceberg. We'll be getting value for those cobalt and PGM that from the nickel units that get delivered, into an EV supply chain. And again, what we think will happen is you'll see integrated EV supply chain participants, integrate their processing, in with large concentrate producers like we expect to be. And now that I have a project, that has a large volume of nickel, I can go, which will be the largest single nickel sulfide mine in the world. I can go have those conversations with the EV supply chain participants.
That was going to be my next question. Why haven't you yet? They needed to see you get to this point. Is that what you're saying?
Yeah, again, right now I'm a junior company who's doing some resource drilling. These guys don't take resource and mining risk. And now that we've got a PEA that I can describe what the project looks like, we're in a location where you can actually get it built. We're in a location where the local community is quite supportive of getting the project built. Those are all the boxes that these supply chain participants are keen to see. And again, we're going to get the feasibility study done, a year from now, which again is pretty aggressive. It's still less than 3 years in total from the first drilling. But that's again, we had been talking about end of 2021. But again, given where we are now and given the demand for resources of all forms, with copper at $4.50 a pound on top of higher gold prices, realistically, mid next year is still going to be aggressive to get there. But we're going to do our best to get there.
Okay, so just on the drilling, this PA is based on drilling from last year.
Yes.
Are you still drilling? You continue to drill into the feasibility study?
Yes. Oh, yeah. No, we've got, within Crawford itself, we've got the extension to the main zone that's, we released earlier in the year that we think it continues for at least another 800 meters to the northwest, or about 40% longer strike length. We've got our filling in our east area where we've got two resource blocks, and we'll be filling in and extending the resource in that area. Then we have our north zone, which we don't have a resource on at all today, but again, will be another nice chunk of resource that will work its way into the overall model. And then we've got the regional exploration, which we just, had the first results from McDermott. So, again, today's mine life is 25 years. Again, I think the resource upside is pretty significant, and the resource that we put out, a year from now. So by the end of this year, we'll be, again, 50 to 100% larger than what we have now. And it just gives us much more opportunity to get higher value, higher revenue, lower cost, ore that we can put in basically the big plant that we've already paid for.
Well, actually, talking of that, there's a question which was sort of asked of us a lot, which is, how do companies like yours fit into the current ecosystem? Because there's not a lot of smelting or refining capacity in the West, which then makes you wonder, is there going to be a dependence on Asian facilities, or can you go it alone?
Yeah, no. I think, again, part of what we've described here is a supply chain that we think can get into place and avoids being held hostage by the traditional smelters and refineries. Again, from a marketplace perspective, First Quantum is now talking about getting its Enterprise mine going in Southern Africa, and that's going to soak up a lot of the smelting capacity that's available today. So, we have a stainless path to market right now. We think an EV path to market co-located with our mine, or somewhere between our mine and one of the auto plants in Southern Canada or in the Northern United States, will be where our nickel, big chunk of our nickel ends up as well by the time we get to feasibility study, and definitely by the time we get the project built.
Why did you use Ausenco to do the study?
Oh, again, if I was a promoter, there's lots of engineers who just do studies who don't actually build anything, and my capital costs could probably be $300 million or $400 million lower. But Ausenco builds projects. Ausenco has a great track record of those projects coming in with capital costs, that are in line with their studies, and have not only a number of their projects have actually exceeded their nameplate capacity, multiple times, that they've designed. I've been talking to people all the way through this to say, okay, if you want to understand the economics of what our project would look like, go look at, the Dumont feasibility study and look at those numbers. And right now our capital costs are higher than Dumont. But, the whole difference in the capital cost is the contingency. Because again, good engineering firms and good companies that have realistic numbers use realistic contingency. So at a PEA stage, the overall contingency is in the mid-20s, with certain components at 30%. Dumont, because it's a feasibility study stage, has a much, much lower contingency number. So there's $170 million US of contingency difference between our number and Dumont. And again, given that it's a similar plant with a lot of similar features to what we have at Dumont, we're pretty confident that, a lot of that contingency will again drop to the bottom line and add value on top of what we've already got in place.
Okay, so talk to me about how something like this gets funded. There's a few detractors, a few commentators in the market saying projects like this, they'll never get funded.
It's the largest nickel sulfide mine in the world outside of Russia. And again, just on the resource that we already have today. It would be the largest base metal operation in Canada in terms of total metal value, bigger than Highland Valley, bigger than Voisey's Bay, bigger than Raglan. And again, the BHP Billitons of the world are not opening exploration offices in Toronto because of the beautiful weather and, wanting to get Leafs or Blue Jays seasons tickets. They're here because they think this market has very attractive nickel copper opportunities, and our project, is of a scale, is in a location where you've got all the infrastructure, which makes it much cheaper to expand than in a remote location. And again, is in a location where you have very broad, deep community support, very broad, deep First Nation support. And, oh, by the way, we'll produce a zero carbon product, in terms of nickel and cobalt and in terms of the iron and chrome product that we're going to be making. So in terms of ticking the boxes for the majors who want to build out their base metal portfolios, I think our project, ticks, all the boxes. And again, I know for some retail investors, billion-dollar price tags are scary, and there's no way that anything could ever done. But again, when you look at the large companies and the mid-tier companies, the mines that they need to build today to deliver, nearly 300 million a year in free cash flow, require, initial price tags of around $1 billion, and just 1 billion is pretty cheap. A lot of the projects they're looking at have 2, 3, 4, 5 in front of the billion number. So, I'm very happy with where this landed. We are already getting good interest. A lot of companies are waiting for the PEA to come out. The PEA has come out. The kind of numbers we're displaying here are the kind of numbers that I know as someone who's worked at a large mining company in the past, mid-teens IRR is what you expect for a large multi-decade base metal operation. That's the reality.
Well, I was also looking at the free cash flow, annualized free cash flow, $274 million. That's not too shabby either.
Yes. Yeah. No, again, because of the significant iron and chrome byproducts, that's why, we're at $1 a pound cash cost and $2 a pound all in sustaining cash cost. And so, again, why the stainless path when you have iron and magnetite, that has anywhere from 2 to 5% chrome, depending on where we are in the ore body. It just makes sense to let that metal go where it wants to go. So.
Okay, well, Mark, I guess the final bit to this is to get the feasibility study done. Have you got enough cash to do that?
Yeah, we're funded. We've been saying all along that we're funded through September based on the cash that we have on hand now, and then we'll be looking to do $10 to $20 million between now and September. As I said, there's a number of strategic discussions that have gone on. We'll see whether they get there or whether, again, we're looking to make the pivot now from a largely retail shareholder base, to start to get to some larger institutions in the story. And again, those are the ones I think, take us up a whole other, level in valuation. And again, given the interest we've seen so far, pretty confident that we'll do pretty well on that front over the next 4 or 5 months here.
And so, are you given the market that you'll be selling into? Are you looking at listing on another exchange anytime soon?
Yeah, no, we're definitely considering a U.S. listing with the zero carbon angle. There's very large pools of capital and large groups of investors that just don't buy TSX resource stocks. So, having a U.S. listing, would be very helpful on that front. So, I think that's something we're definitely considering and could pop up sooner than later.
Okay, Mark, I appreciate your time today. I know you're busy. It's middle of, you've got a one-to-one conference going on as well. So we'll see you soon.
All right. Thanks, Matthew.